I'm Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We have a great show for you this morning. Of course, we will be taking your email questions. Please send those to Brian Rezny at ReznyWealth.com. And make sure you do visit our website. Check out our consultation page. Check out our investment services. If you're concerned about the advice you're receiving, if you're looking for a second opinion consultation, we have offices right here in Naples and in Fort Myers, right down the street from your house. Very convenient. Maybe it's time you sat down with us and talk about your portfolio. Maybe you have a few concerns about the advice you're receiving, or maybe your portfolio is not living up to your expectations or meeting your retirement goals. We'd love to sit down, discuss, and see if we can build a better plan for your financial security. You know, I've got a lot of things to talk about today. I want to talk about investment strategy, emotions, things that often hurt investors. Generally speaking, the economy in the U.S. is doing quite well, and I expect, of course, volatility within some of the investment markets, but I expect the overall economy to continue to grow and prosper. We're looking at decent corporate earnings within the U.S. marketplace, and other areas around the world are also starting to pick up a little bit of speed, which I also like. Remember, we're a global economy, and if other countries do well, that gives us, the U.S., even a better chance to expand and increase our wealth. Emotional investment decisions are dangerous to your money and your future investment returns. I want to talk about this because, again, I've been managing money for over 30 years. One of the areas that I try to really educate investors on is having an investment strategy and not making emotional decisions, but investors do it all the time. If one investment in their portfolio is doing really well and another investment's not doing quite as well, investors will make an emotional decision. Well, let me sell the one that's not doing quite as well and load the boat with the one that's really doing well, only to have that investment then come crash and burn. That's an emotional investment decision, and it often will hurt your portfolio returns. And I see investors play that mistake out time and time again. Let's educate you today so you do not make those mistakes, and hopefully you make more money, have more financial security, and have more wealth. Worst start of the year, 2016, sell everything. If you remember in 2016 in January, it was the worst start of the year. That was actually a headline that was actually talked about by a lot of the different Wall Street firms and investment people out there on how it was the worst start of 2016, sell everything. Bad mistake. If you've listened to my TV or my radio shows for any length of time, you know that I told people back in 2016, don't sell, reposition your portfolio. We've got a growing economy. We don't have a recession in sight back. This is, again, last year. We were spot on. Hopefully you've been listening to my show long enough and you made the right choices with your money. As January goes, this again is last year, so does the year. That was the refrain when 2016 began, with the worst start ever. The Standard & Poor's Stock 500 index fell about 10.5% over a 28-day period in the month of January, again, in 2016. And Wall Street firms, the way January goes, so does the year. Well, guys, I don't know if you remember in 2016, but we actually ended up the S&P over 10% for the year. So not only did it make up that 10% drop that it had in January, but it went up another 10%. If you were in small caps, you did even better than that. Stocks fell because of imminent China collapse. That was some of the other headlines. Or earnings recession. Or election uncertainty. Remember Donald Trump and the election? Election uncertainty. The market was going to drop. Guess what happened after Donald Trump actually won the presidency? The market went up after that. The bull market is long in the tooth was another catchphrase by a lot of these Wall Street firms. Folks, I'm here to tell you, Wall Street's not your buddy, and they're usually wrong most of the time, at least what I've seen, and I've been managing money for over 30 years. As an investor, there's investment money managers like my firm, which are fee-only fiduciary money managers, and then there's a lot of salespeople, which is the vast majority of Wall Street firms, banks, and annuity salespeople. The problem is investors often don't know the difference. You, the investor, remember, follow a strategy, have risk management, and when you do need to sell or get conservative, then you do it. But do not listen to a lot of this hype or emotions it will wreak havoc on your portfolio. There were plenty of calls to sell everything in January and February of, again, 2016. That is rarely good advice. It was especially bad advice in the first quarter of 2016. Had you sold in January, you would have missed, get this, a 45% rise in small cap stocks. If you would have sold last year again when the Wall Street firms told you to sell, you would have lost 25% gain in large cap stocks. And again, if you would have sold based on Wall Street's advice, again, bad advice, you would have missed a 31% gain in emerging market equities or stocks also. Bottom line, Wall Street was wrong. They're often always wrong. Their goal is to sell you investments that are often not in your best interest. And that holds true for the bank sales representative and for the annuity people out there. Make sure the advice you're getting is not coming from suitability, but it's coming from a fee-only fiduciary firm. And remember, hype, hoopla, and these calls to sell everything are almost never correct when it comes to Wall Street firms. Investment strategy, not emotions or hyped up news media. As an investor, you have to follow a strategy. If you are unable to follow a strategy, find yourself a firm that actually manages money that also has an adaptive strategy to manage risk in severe down markets like a recession. We have recessions about every 6 to 7 years. Sometimes they're 18 years apart, sometimes they're 3 years apart. Currently, the economy in the U.S. is growing. We're not seeing an overheated economy. We're not seeing signs of recession. You as an investor, be adaptive, don't use emotion, and remember, Wall Street, banks, and insurance companies are not fee-only fiduciary money management firms. I'm going to take a quick break. I'm going to be back with your email questions. Make sure you visit our website, ReznyWealth.com. I'll be right back after this. Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report Sunday mornings throughout Florida. For 30 years, I've helped investors solve their biggest investment and retirement risks. I now see 3 major investment risks that I'm alerting investors about in a groundbreaking free special report. 3 investment risks you must avoid now. If you have at least a $500,000 portfolio, get your free report today. And we're back. We're going to take your email questions. Send them to Brian Rezny at ReznyWealth.com. And of course, if you have any concerns about your portfolio, the advice you're receiving, if maybe your portfolio returns are lacking or you're not meeting your retirement or pre-retirement goals, call Rezny Wealth Management for a consultation. We have offices right down the street here in Naples and also in Fort Myers. Visit our website, ReznyWealth.com, and make sure that you download our newest report, 3 investment risks investors must avoid now. It's a must-read report for any investor who's concerned about the current market state, your portfolio, and your financial security. Go to ReznyWealth.com to get your free copy. Again, limited time offer. Andrew from Fort Myers, Florida. I only have $150K to invest and I can't afford to lose it. I'm investing in high yield preferred stocks. Does that make sense in my situation? Andrew, first off, if you tell me you can't lose it and you're invested in preferred stocks, you could lose it. Preferred stocks can go down 30, 40, 50%. They did in the market recession and crash of 2008. And if we have another recession, preferred stocks can go down again. So when you say you can't afford to lose it, but you're invested in something that can be highly fluctuation or fluctuate quite a bit, it doesn't make a lot of sense. What you need to do, Andrew, is understand, does it mean you don't want to lose all your money, or can you accept some volatility in order to get a return on your money? There's a big difference. Nobody wants to lose their money, but you cannot make a return on your money unless you're able to accept some moderate volatility. The big thing, if you have all your money in preferred stocks, you're in one asset category. You're not diversified. And also preferred stocks, Andrew, act very much like long-term bonds. So when rates start moving up, preferred stocks will probably do not so great. So again, if you're talking about not losing your money, you're probably invested in exactly the wrong place at exactly the wrong time. You definitely need somebody to help you professionally manage your money because you're too lopsided on your portfolio and you probably are not running a strategy for growth, income, and it doesn't sound like you really have a risk management strategy either. Randy from Bonita Springs, Florida. What is your opinion of municipal bond closed-end funds? They took a small hit in the past week. The yields on these CEFs are reasonable. Randy, first off, a CEF or a closed-end mutual fund, most of them I do not like. In fact, I would probably use the term, the number of 85 to 90% I don't like. Closed-end mutual funds, whether it's bond funds or stock funds, the problem that I don't like with these is there's underwriting fees, there's often a lot of leverage, and they pay what's called a distribution rate. So let me explain. Unlike if you went and just bought a bond, and a bond, let's say at a coupon, and was currently paying you 3%, you're going to get 3%. If the bond matures in 5 years, you'll get your principal back. When you basically buy a closed-end fund, a lot of these tout these high distribution rates. It's not your yield, it's what they're distributing from the fund. Some of that might be income, and some might be capital return. So what happens is people buy closed-end funds because they look like they're paying a lot of money, but some of that money potentially could be your own money. Then you throw on the leverage factor. I've seen a lot of closed-end funds that have leverage approaching 40 and 50%. That's a risky venture. So again, there's better ways, in my opinion, to have an income stream from a portfolio. I'm not a fan of closed-end funds, at least the majority of them, because they're either A, expensive, they're levered, they're paying out distributions, they're often return of capital. Investors get suckered into these things, to put it bluntly, because of the high distribution, because they think that's what they're making, and often it's not the case. Eleanor from Marco Island, Florida. I would like to put my husband's IRA and my IRA account into the best dividend-paying stocks and use the dividends. What do you think? Eleanor, I think that's a mistake. Instead of buying a group of individual stocks, like let's say 10 or 15, which is going to give you a ton of volatility, I would have you build a portfolio out of, let's say, exchange-traded funds or ETFs. You'll be more diversified. You can still generate dividend income, but you'll be more diversified in various sectors than buying 10 or 15 of the best dividend-paying stocks. Also, there's been a lot of studies on this too. If you just buy high dividend-paying stocks just because they're highest, doesn't mean you're really making a lot of money. You might make a high dividend, but your principal may be going down. So your total return actually is not that great. Total return is the gain or loss of the value of your money plus the dividend you receive. So if you had a 4% dividend-paying group of stocks, Eleanor, and you lost 6% of your value of your money each year, what's your real return? It's -2. People have a false idea that dividends are a good thing. Sometimes they are, sometimes they're not. And also, Eleanor, dividends can be cut. I think a more appropriate strategy is a better diverse portfolio. Utilize ETFs, still look for a dividend stream, but go for total return. I think you'll be better off in the long term. Or better yet, call my firm for a consultation. We have offices right down in Naples and in Fort Myers. Pam from Miami, Florida. What do you think of the Apple split? Is it a time to buy? Are splits good for stocks? Apple did split last year, and generally speaking, splits are not necessarily good or bad for stocks, Pam. People think just because a stock splits, that's a magical reason to buy it. Absolutely not. Again, a lot of studies on this. Sometimes it's good, sometimes it's bad. Apple, I think, is a good company. I don't think it's a great investment, but it's a good company. One of the things, the problems with Apple is it's very over-owned by a lot of the big institutional houses. Again, Be diversified, Pam, because if Apple doesn't do well, you have all your money or a lot of it in one stock, not a smart process. Bill from Naples, Florida. With the market trading at close to a new high, should I be selling? Bill, no. Just because the market's trading at a new high, that statement would have been true 5 years ago, 10 years ago, 15 years ago, 20 years ago. So the bottom line is this. The market progressively goes up and down and typically at new highs. Not a guarantee to the future, but if corporate earnings and the economy keep expanding, there's a high likelihood that the stock market will gradually keep going up. Just because the market's high doesn't mean it can't go up another 40 or 50% until it comes down. In fact, corporate earnings are on a growth spurt. If some of the new president's agenda gets passed, all the tax reform, all the rules and regulations, healthcare is fixed, and other issues, I think we have a market that potentially, who knows, could double in the next 5 or 6 years. So would I sell now? Absolutely not. Would there be a time that I'd want to sell? Yes, when things are overheated, or if there's specific areas that you have in your portfolio that are overvalued. Roger from Fort Myers, Florida. What if my company's 401k plan is lousy? What should I do? Couple things, Roger. First off, if you work for a company, can you do an in-service transfer into a self-directed IRA? Or if you're not working for that company, can you move that 401k plan to a self-directed IRA? So that's one option. Number two, if you can't move the money out of the current plan into an IRA, you're stuck with your lousy investments. All you can do is do the best you can with what you've got until there is a point when you can then move that money out. There's a lot of companies today, Roger, that allow you to move money outside of your current 401k plan, even if you're working or a percentage of it, into a self-directed IRA and have it professionally managed. So again, check with your human resource department if you can do that option. If you're currently not with the company, you could definitely then roll it over into a self-directed. You can always call my firm for help on managing those proceeds. I'm going to take a quick break. Visit our website, ReznyWealth.com, and as always, never settle for bad advice, or if you have questions about your portfolio or concerns, call my firm for a consultation. Get that needed second opinion. We have offices right here in Naples and in Fort Myers. I'll be right back with more questions after this. Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report Sunday mornings throughout Florida. For 30 years, I've helped investors solve their biggest investment and retirement risks. I now see 3 major investment risks that I'm alerting investors about in a groundbreaking free special report. 3 investment risks you must avoid now. If you have at least a $500,000 portfolio, get your free report today. And we're back. We're taking your questions. Of course, send them to Brian Rezny at ReznyWealth.com. Please visit our website, ReznyWealth.com. Download that groundbreaking report. We are getting just great comments about the information in that report. 3 investment risks investors must avoid now. It's a must-read report. If you're a pre-retiree, retiree, you're concerned about some of the problems out there currently in the economy, geopolitical events, what have you, go to ReznyWealth.com. Download that groundbreaking report. It's free, and it will be for a limited time only. So go there as soon as you get a chance. Mary from Coral Gables, Florida. I own 4 variable annuities from Allianz. 2 are IRAs and 2 are individual. My advisor is recommending I transfer them to an Aviva equity index annuity with security benefit. What do you think? It sounds to me, Mary, that your current advisor, first off, is not an advisor at all. He's really a broker salesman of annuities. Okay, so while I'm not going to speak specifically on those annuities, what I'll tell you what he's doing is he wants to take you out of annuities you're already in, reload you in a new surrender penalty, or you'll pay a surrender penalty coming out, into 2 other annuities. That is a huge mistake. What you will often see, and again, I've been managing money for 30 years. We do not sell annuities. In fact, I hate and despise annuities. You can read my report on my website, Why Annuities Are Dangerous to Your Wealth and Retirement. But your salesperson, not advisor, annuity salesperson, or annuity charlatan, as I often call these people, want to basically take your money, put it into another annuity to reload it for a commission for him or her. This is going to do little, if anything, for you other than probably give you higher expenses internally and put you in another surrender penalty to get all of your money out. You should fire this person immediately. Find yourself a fee-only fiduciary money manager. Your person is no more than a salesman. And go to my website, reznywealth.com. Read our free report, Why Annuities Are Dangerous to Your Wealth and Retirement. Make sure you read it once, twice, highlight it, read it again, and you'll realize annuities are no good for you. There's better opportunities for your money instead of surrendering your money with big penalties and high expenses to the insurance companies. Joan from Fort Lauderdale, Florida. Can you explain fiduciary versus suitability? Yes. Fiduciary means we're a fiduciary money management firm. We're a fee-only fiduciary money management firm. We legally have to always put your interest ahead of ours. We always have to give you the advice that is legally best for Joan. When you're working with a brokerage firm, a bank, an insurance agent, somebody selling annuities as an example, most of these people work under called suitability. And suitability means they only have to sell you products you're suitable to buy based upon your risk profile. They could be expensive, they could be lousy performers, but they just have to be within your suitability. So they don't legally work for you. Also, if you're working with a brokerage firm, bank, or an insurance company, and they're working on commission, which most of them do, of course, they're actually working for the brokerage firm when they're selling you these investments. They're not legally working for you. So fiduciary, legally working for you and have to do what's right for you. Suitability, you've got yourself a salesman selling you probably high-priced, high-commission investments that are not in your legal best interest, and they actually don't manage that money once they sell it to you. Rob from Miami, Florida. Gold, silver, gold stocks have taken a beating in the last 3 years. With these rock bottom prices, is now the time to invest. Rob, gold has actually popped back a little bit from its beating about 5 or 6 years ago. It's still down, of course, from its high. I'm not a big believer in gold and silver. A lot of people buy these things because the world's coming to an end. If the world came to an end, guess what? It doesn't matter if you own gold or silver. Gold and silver are really hyped investments, often sold, and what I find is people get involved in these things with high markups with little value. I would not be buying gold or silver now, and if you owned it, I'd be a net seller, but I wouldn't be looking at it as an investment. I think there's better opportunities, and one of the things I will warn investors about, you see a lot of these commercials on TV about gold. Most of these commercials are to sell you overpriced gold bars or silver bars, and a lot of them are to sell you gold and silver coins, which are often even higher markups than selling you gold and silver bars. So there's a lot of gimmicks out there on these commercials. Make sure you read the fine print. When somebody's selling something, that means they're working under suitability, and they don't legally work in your legal best interests. Dean from Naples, Florida. Do you like small cap stocks? I sure do. In fact, in our managed accounts at Rezny Wealth Management, we often own small cap stocks within our managed accounts across the board, even in conservative accounts. We will traditionally, Dean, use what's called an ETF, an exchange traded fund, or multiple ETFs in the small cap marketplace for some of our clients' money in our managed accounts. I think that's one of the better plays, one of the better ways to play small caps. You're more diversified. So think about this. Small cap companies are companies that are usually under a market cap, usually under $10 billion, let's say, between 5 and 10 and under. These are smaller companies. Think of Walmart 35 years ago. It was a small company. Small companies can grow into the big giant Walmart they are today. They have that opportunity. The problem is large cap companies like Walmart often then peter out because they're so big you can't move the needle. I like small cap. So if you're an investor, whether you're 20 or whether you're 80, if you're trying to grow some of your money for longer term use, long term to me is more than 3 years. Having a percent of your money in small caps is an opportunity. And I'll give you a little advice. When small caps lag the large cap stock market, which often will happen year by year. So let's just as an example, small caps lag the overall marketplace this year against large cap. Now's the time you want to start adding small cap exposure because it's usually reversion to the mean. They may then catch up next year. Great opportunity. Look at them when they are lagging overall. Sharon from Bonita Springs, Florida. My broker wants me to cash in an annuity I have for another he says is better. I have been burned before on annuities. What do you think? Sharon, you're going to get burned again. Your broker only wants to cash you in out of an annuity to better his commission and his pocketbook. There's not a better annuity. It's basically a sales pitch by your salesperson who is a broker working under suitability for a commission. He wants to take you out of a current annuity, load you back up on another big surrender penalty into another annuity. I see this happen all the time. I've been managing money for 30 years. I have seen so many gimmicks with annuities. I've seen so many blatant lies coming from brokers and annuity salespeople. It makes me sick. The other thing that I see is unsuspecting seniors who show up to these free steak dinner seminars and then are sold a bunch of annuities and they're told they're going to make these extravagant rates of return, which turn out also to be lies. I find annuities are often sold on blatant lies or misinformation. If you want to learn more about why annuities are dangerous to your wealth and retirement, go to my website, reznywealth.com. There's a free report there for the download. Read it twice, read it 3 times, take notes, but never ever buy an annuity. What I would suggest, Sharon, fire your broker, get yourself some real advice, find a fee-only fiduciary money management firm. I suggest calling my firm. We can sit down with you, review those annuities, and tell you exactly what's really going on and what you should be doing differently if you're ultimately trying to better Sharon's scenario versus your salesperson. Folks, I'm just about out of time. Results, retirement security, peace of mind. Let's face it, that's what we all want. Experience the Rezny Wealth Management difference. I've been managing money for over 30 years. We have offices right down the street in Naples and in Fort Myers. We are here to help you build your financial security and help you achieve your goals. My advice, never settle, get a second opinion. If you're concerned about the advice you're receiving, if your returns are lacking or you're not happy with the returns on your money, maybe it's time to sit down. I know change is often difficult, but it doesn't hurt just to talk. Make sure you go to our website, and I'll see you next week.